Hi, this is Stephen here from Navigator, and today we're sharing with you the short put strategy. So it's a credit. That means you're getting paid in advance to place the trade. So here's the overview of what we're going to cover today. We're going to go live to the market, show you real life examples and how you can actually practice risk-free placing this particular strategy. This is one of my favorite strategies, and it's a mildly bullish strategy. So you're mildly bullish on the stock. If you are more bullish on a stock, the best thing to do would be to buy the stock or buy a call option. So this is mildly bullish. So what is the strategy? Well, the bottom line is you're getting paid in advance to insure somebody else's shares at cheaper prices. Now, your psychology can be very different. This can be a return-based strategy, or you could be using this strategy to actually get assigned shares. So let's look at it at a return-based strategy. This is where you don't want to own the shares. So you're choosing strikes that are further out of the money. That will become clear as we go through the presentation. But let's say, for argument's sake, you like McDonald's, it's trading at $98 at the moment, and let's say you are really happy to own it at 95. So you don't want to wait for it to fall to 95, you want to get in the game straight away. Well, you could write the $95 puts on McDonald's and start getting paid in advance to place that particular trade or to get assigned the shares at 95. If the shares drop below 95, you're going to buy the shares at 95. If the share price remains above 95, you won't get assigned the shares, but you keep the premium you've received. The great thing about this strategy is you can dictate the probability of success. The further you go out of the money with your strikes, the higher the chances are of you not getting assigned on this particular trade. So we've said it's mildly bullish. It's a credit spread. You get paid in advance to place the trade. Now, there's a great time to place this. We'll go through this again later on. You place this trade when implied volatility is higher, and the reason is option premiums will be higher then at that particular time. You're going to get paid more for insuring the shares. And then what you want after that is implied volatility to decrease, because then the option premium will devalue, and since you've sold the option in the first place, you could buy it back cheaper to make your profit. So how do you actually place this particular trade? Well, it's really simple. You just sell a put option at the strike price, and usually we go out of the money. So let's go live to the markets. Let's practice this. We're in the Interactive Brokers website here, so you can see that in front of you right now. And what we're going to do is we're going to go into trading. We're going to click on platform demos. And there's two particular platform demos you can see here. We're going to click on the web trader demo. We feel that's the best one to start practicing on. So what happens here, we're going into what we call a dummy account. So you can't make any mistakes in this, guys. This is monopoly money you're playing with. It's a great way to practice trading. And as you can see here, we've got our demo system open here in front of us. So we get straight to it. So we're going to click on options. And you can see here we have Microsoft, Apple, eBay. We could put in McDonald's there if we want. But because Microsoft is open in front of us, we'll place the trade on Microsoft. So today is the 14th of May. Let's say we like Microsoft. It's currently trading at $48, but we don't really want to buy this till it gets to 45. So we're going to allow the shares drop $3 and still get paid for doing that. So we're going to look out to the 19th of June strike prices. And you can see a whole list of prices are opening up here. We've got calls on the left, puts on the right. So we're going to look at the puts on the right hand side, and we said the $45 strike. So you can see here at the moment, we've got a bid and an ask here of 70 cents and 68 cents. So we're getting paid upfront 68 cents per share for agreeing to buy Microsoft or insuring the shares of Microsoft to the value of $45, which is $3 cheaper. So we'll just click on the bid price, and you can see the order management window pops up here in the Interactive Brokers site. And it automatically says it's going to sell one contract. So remember, in the options market, options are bought and sold in contracts. One contract controls 100 shares of stock. So sell one Microsoft, 19th of June expiry, $45 strike. It's a put option for a limit price of 68 cents. So we're happy to place that particular trade. We're going to click on preview order. And what happens is your last chance saloon pops up. Are you sure you want to place this trade? So you can see we're taking in here $68. The trading commission is going to be anywhere between 75 cents and $1.45. So we're getting paid this in advance for agreeing to buy the shares of a stock we want to own $3 cheaper than what it's currently trading at $45. So we submit the order. So the order has gone into the options market there. And you can see we're after getting filled there. So now we own that position. We'll show you what it looks like on your account. So we'll scroll down here and you'll see here Microsoft -1 because we've sold it. Our average cost is 67 cents. So this brokerage house takes into account your trading commissions in your average cost. And that's the position we have there at the moment. So we just have to wait now till expiry Friday. If the shares finish above $45, nothing happens. If the shares finish below, we'll be asked to buy 100 shares of Microsoft at 45. So let's get back to the presentation. So we're going to use a real life example. That's just a dummy account. So we're actually going to talk about a trade we placed in our account on Macy's. So on the 12th of May, Macy's was trading at $65.31. Earnings were being reported the next day. Implied volatility is high because of the earnings announcement. So we want implied volatility to fall. So we went in and said, right, we're going to take advantage of implied volatility being high. So what we did was we sold the Macy's June 19th $60 put option and received nearly 62 cents per share after costs. So our net credit was $61.50 per contract. So we were going to allow Macy's fall nearly 531 or even more and still make a profit on this particular trade. So what was our risk here? Well, technically with this short put strategy, your risk is undefined. But in reality, it's not really. The risk is technically if the shares fall to zero. So if Macy's in this case went to zero, we've agreed to buy the shares at 60, so we would have to fulfill our obligation there, minus the credit we received. So technically our total risk is $59.38 per share. Having said that, the reality is that it's highly unlikely in a month that Macy's is going to go to zero. So it's not really defined risk as such. So we're giving ourselves plenty of leeway for this trade to go wrong. So let me describe that in further detail. Let's talk about our max profit first of all. So our max profit in this trade is the amount of premium we've received. It's simple as that. And it's achieved when the share price finishes above the short strike price. So we picked the $60 strike. You can see here our profit is absolutely limited here. We can't make any more than the premium we've received in this particular trade. That's it. Once the share price finishes above 60, we're going to make our full profit. What is our break-even point? Well, the break-even point is the strike price, which was $60 minus the credit received. So for our Macy's trade, that was $60 minus 0.615, which is what we received in the premium. So our break-even point is if the shares finish above $59.38. So our leeway in this, it's really important to calculate your leeway for success here. Because the share price of Macy's was at $65.31, we know our break even was $59.38.50. So shares can fall $5.93, let's call it, before we start to make a loss. And in percentage terms, that was 9%. So we're allowing the shares of Macy's to fall about 9% in a month before we start to lose in the trade. That's why I love this trade so much. When you buy a stock on any given day, you really have a 50-50 chance on that day whether it goes up or whether it goes down. What we have done here is gone way out of the money at $60 on the put. We've allowed the shares to fall 9% and we're still making money. So that's a much better odds for us to win in this particular trade. In fact, the odds were about 84%. So what is the effect of volatility in this trade? Well, we want to place the trade when volatility is high and we want to buy it back when volatility is low. So when implied volatility drops, we profit in this particular trade. It has a positive effect on our option. What is the effect of time decay? Well, if you think about it, we're selling time. We're basically agreeing to insure a share between now and the 19th of June. And as each day passes by, the value of that insurance will decrease as well. So time decay is positive for this strategy. And that's really the name of the game. We're using volatility and time decay to our advantage here in this particular trade. So how did we go about picking a strike? Well, it really depends on your mindset. Do you want to own the shares? If you want to own the shares of the stock, you would normally pick a strike that's closer to where the share price is currently at, or the strike at which you're happy to buy the shares at. So for example, if you like Apple, Apple's trading at about $125 at the moment, and you really want to own them at 120, well then sell the $120 puts. But if you want to do what we've done there with Macy's trade, which is just a simple return-based strategy, we were trying to take advantage of a reduction in implied volatility after their earnings announcement, we would pick a strike that's far out of the money with at least an 80% chance of success. So most brokers have option trading software that will tell you what your probabilities of success are. So you don't have to go into Excel yourself and start working it out. They'll do it for you. So basically you'll just have to plug in the share price outcome. You know it needs to be above $60, and they'll tell you what chances that event has of occurring between now and expiry Friday. So how do you manage the trade? Well, what happens if the share price falls below the strike price? Well, you have two real choices. If you want to own the shares, you do nothing, and what will happen is your broker will literally buy the shares off the person that you insured for you. So that'll literally, you'll see the 100 shares in your account on the Monday after expiry Friday. But if you don't want to own the shares, you can do a number of things. You can buy back the put option and take a loss, or you could roll the put option out to the following months for a net credit. So we're going to go into our trade now in a moment for you and just show you what it looks like. So what does it look like? For example, here we have our Microsoft trade. So let's say, for argument's sake, this is due to expire in June. So let's say it's the 18th of June now, we're just about to expire and this position is losing. What could we do here? Well, as I said, if you want to own the shares, that's fine, you take assignment of the shares. But what you could also do is roll out the contracts to the following month, and you're going to get paid even more premium. So let's click into options. Let's bring up Microsoft again. So we know there that we'll have to pay 69 cents to buy back this particular put option. That will close our obligation down. So we're not obligated anymore to buy the shares at $100. But let's say we still like this particular trade, we don't want to close it down at a loss, we're going to roll it out to July, and you'll see we'll pick the exact same strike for July, and we're getting paid more. We're getting paid 85 cents to place it. So if you think about it, in June we're spending 68 to buy the put back, and then in July we're getting 84 in to extend it out another month. So we're making another 16 cents a share here for extending the time duration. And that again is the benefit of time or theta working for you again. Okay guys, that's the short put strategy. Very powerful strategy. Please visit our website, share it with your friends. All of our training is free, and you can also get live trades that we're placing as we trade. This is Stephen from Share Navigator. Thanks and bye for now.